Hi, my name is Jamie Shi. I'm currently a business economics major pursuing a career in finance. So, just recently, I had a really good conversation with one of my friends who's a real estate major, and we were just talking about how hard it is to live in places like in Manhattan and San Diego, and just the barrier of entry to even consider living there is just exponentially high. And that got me thinking about the relationships between the housing markets, the governments, and the banks. And it all comes down to credit and how easy it is to lend each other money. So, this is what this project is all about. So, how the regulatory easing under the Trump administration really affected bank risk taking and lending conditions. So, a quick context here is that Trump administration really pushed a lot of deregulation back in 2020 or 2017, especially the finance deregulations. So the financial regulation directly affects the lending behavior, the risk taking, and financial stability. So my thought process is that if regulation changes incentives, then the financial markets should react immediately upon that. So, what specifically changed? So, from 2017 to 2020, the Trump administration really pushed the reducing financial regulation introduced after the 2008 market crisis, which a little context in the 2008 financial crisis was that a lot of mortgage bonds were wrapped up with triple A graded insurance, but in reality, it weren't really all triple A, and there's a lot of people who couldn't pay off their mortgages, and that created a domino effect of a lot of people losing money. So the started goal was to lower compliance costs, improve banks' profitability, and encourage greater lending. So the regulatory changes focus on capital requirements, stress testing, reporting rules, and trading restriction. So because bank operates under the strict regulatory constraints, even the small policy changes can really affect risk taking and market valuations. So my research questions are bank stock responsive to deregulation announcements? Number two, the bank risk taking after deregulations. And number three, the credit conditions after the deregulations. So why does this matter? Banks are extremely sensitive to regulations and interest rates, and markets often react to expectations before fundamental changes. And this helped the difference between short term market moves and real long term values. So my hypothesis is bank stock earned positive abnormal returns around the deregulation announcements. The second, bank risk measured volatility or beta increases after deregulation. And number three, the credit spread narrow and lending increases the post deregulation. So this is my timeline of how I'm going to collect data, how I'm going to clean the data, and how I'm going to read the data. So the first thing I want to do is to identify the regulatory events. Number two is to collect the market data using Python and construct a returns and events window of how long and how much I'm going to collect each data from each regulatory event. And number four is to build the analysis data set. And five, using Stata, I can analyze the data that I sifted through. And finally, I'll interpret and visualize the data for us all. So the data step one is to identify the financial deregulation events. The event must meet all three criteria of publicly announced, directly affected bank regulations, and occurred during the US trading day. And if not, I'll use the next trading day. The events type also falls into four categories, which is the legislative actions, the regulatory rule changes, the agency guidance or reinterpretation, or the high signal policy statements. So this is my CSV file. I manually curated the regulatory event file. So the key variable here is the event dates, the event types, and the event strengths, which is the expectation settings versus the legally binding stages. So this is my Python script that I made for the data collection and processing. So I had a research setup, I had data downloaded here, and then I loaded the events, download prices, events window constructed. I did 7 to 5 days around, and then I had the panel format of what the data should look like and how it should be organized. And then running that, this is what I got from the data collection, which you can see on the left is the dates, and then the event states, events name, events type, strengths, ticketer, and the banks and the benchmarks. And using that data, I went over to Stata to analyze the data that I collected from my script. So this is my Stata output with the 6 events that I picked. So what does this actually tell us? So the banks earned a positive abnormal returns leading up to the deregulation events. So a sharp jump at t equals zero kind of tells us that investors reacted immediately and positively when the deregulations was announced. Cumulative abnormal returns, the CAR, peaked right around the event, which implies that the value impact was front loaded instead of gradual. The price gains reversed after the event, suggesting they were driven by expectations instead of fundamentals. So the market prices in a positive expectation around deregulation in the short run, but the gains did not persist beyond a few days. So my analysis and my next steps if I want to pursue this. So my empirical insight is that the market reaction mainly reacts to expectations about regulations instead of long-term changes in the fundamentals. So further pursuing this, I would like to compare banks with high mortgage exposures to others, see how changes in interest rates affects the results, and finally test whether results hold under different assumptions. So the potential issues and limitation that I faced is that this analysis really captures the short-term market reactions instead of the long-term changes in the bank fundamentals. So market reaction may occur before announcements. So events may overlap in time and results focus on short-term events, and benchmarks may not fully isolate bank-specific returns, and other macro factors could also affect the results. And this is my works cited. Thank you.